Okay, so we'll start with this first question, which is fence company, right? So this question is on cost of capital, but addresses some of the key aspects of it, right? So it will be a very good question to start off with and part of a good revision as well. So our objective is to cover all sorts of costs of capitals, which is equity and debt, both redeemable, irredeemable, if possible preference shares and bank loans. And then we'll do a couple of questions on business valuations, right? So target is to complete 5 questions today. Worst case, 4 questions. We can't go anything less than 4. Okay, right. So it says here the equity beta of fence company is 0.9, and the company has issued 10 million ordinary shares. The market value of each ordinary share is 7.5. The company is also financed by 7% bonds with a nominal value of 100 per bond. Now, as part of the revision, I will have to also tell you that when it comes to a bond, they don't necessarily have to give you the nominal value, right? You have to always know that the nominal value of a bond is $100, okay, which will be redeemed in 7 years' time at nominal value. So here you have to understand there are 2 types of finances. One is equity, my issued ordinary shares of 10 million, and I have 14 million in terms of bonds, right? So interest on the bonds has just been paid, and the current market value of each bond is 107.14. So market value. Fence company plans to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project X company. Now, when you read this sentence, what is the first thought that comes to your mind? Okay, the grid I gave. What is the grid I gave? This Abdullah. So I told you that if there is a change, right? So in the grid that I gave you looks something like this, no? Right? Here there is no change. Here there is change. Let's assume finance risk on the top, business risk at the side, no change, change. So when there is no change, we always said, okay, we can use WACC. And when there is a change in business risk and no change in financial risk, we use something called risk adjusted cost of capital. Risk adjusted cost of capital. So in this question, when they say there is a plan to invest in a project that is different to its existing business operations, you know that you're moving into this quadrant of this matrix. Okay. So if you have this in your mind, it becomes much easier for you to then realize, okay, I know that when I read this sentence, as per the matrix given in class, this is where I will land. Okay, where I will land. Or you have to understand that your final outcome will have to be this, regardless of whether the examiner directly asks you or not. Sometimes the examiner can be a little indirect. So don't blame the examiner. Let's take it upon ourselves. Okay. The equity beta of Hex company is 1.2. Okay, so that's the proxy company. And the company has an equity beta or market value of 54 million. Market value of debt is 12 million. The risk-free rate of return is 4% per year, and the average return on the stock market is 11% per year. Both companies pay corporate tax at a rate of 20% per year. Okay, for 7 marks, they're asking you calculate the current weighted average cost of capital of fence company. So when they say current, what does that mean? This word current is important. Current would mean before you take upon this new project, there is an entirely different business operation. Before that, that is current. So if you're looking at current, there is no change to business operations, which is your first paragraph, where you can work out your WACC. Okay, so I'll give you 2 minutes, quickly work out a WACC for 7 marks. Okay, just my thoughts. When you're working out a question like this in WACC, okay, my suggestion, you don't have to consider it, right? My suggestion is for you to always write down your formula, right? Write down your formula and see what are those elements that you really need, right? Because there's no point of, doing something and then realizing, oh shit, I don't require this at the exam. So, suggestion is, if I was you, I would do something like this. I would write down WACC and I would write down an equation for WACC. Here I'm very clear that I have only 2 elements considering both cost of equity. So I'll say KE into BE plus KD, don't forget to take 1 minus T because there is tax involved in it, into BD. The whole thing I will divide by value of equity plus value of debt. That's your WACC equation, no? Correct? So if I was doing this at the exam, the first thing I would do is write this down, because this will then tell me I need 4 elements to be found. I need my cost of equity, value of equity, cost of debt post-tax, and value of debt. Very simple. Always at the exam, figure out how you can earn easy marks. If you look at all of these 4 elements, which is the easiest to find? Obviously, value of equity. Second easiest will be value of debt. Third easiest will be cost of equity, and then cost of debt. You with me? Right? Okay. So what I'm going to do separately to this, I'll just leave some space to write down WACC once again to do my workings there. I'll have a small heading to say market values. Market values. And then I will work out equity. Equity. How do you find the market value of equity? How do you find market value of equity? Yeah, how do you find the market value of equity? Come on, very simple, no? What do? You take the number of shares and multiply it by NPS. Examiner can be a little tricky sometimes. When you write things like this, it will make you start thinking, okay, now does the examiner really give me the number of shares? In this question, yes. Does he give me the market price per share? In this question, yes. He gives you, right? But if he doesn't give, then what do I do? Then he may have given you an alternative to find market price per share. He can even do that. Now you can't expect it from the examiner that he gives you the market price per share. Okay? So I'm taking the entire objective as WACC. I've broken it down into cost of equity, value of equity, cost of debt, value of debt. Then I'm taking that individual element of equity and then asking myself, okay, can I find equity from the information given? Very simple. Okay, so I have a logical approach to how you do an exam question. NPV, I gave you the format, no? You just stick to the format. But when you're doing a question on cost of capital, you have to always have a methodical way of doing it. Otherwise, you will start doing things which may be not relevant in the exam. or you might get stuck halfway through because you don't have vision where you want to go. Okay, so make life very easy for you. Okay, right. So then you calculate your value of equity here. So we have 10 million shares into price is 7.5. So which will give us 10 into 7.5, 75 million. Okay, 75 million. Then you can calculate debt. Now ask yourself, how do I calculate market value of debt? How do you calculate market value of debt? Yeah. Anybody? How do you calculate market value of debt? Hmm? Come on. Somebody has to tell me. Because we are walking distance away from exam, no? You start walking today from your house. On June 4th, you will reach at the exam. Walking distance away from the exam. Especially Abdullah. You start walking today, June 4th, you will be in the exam. June 4th, no exam. 6th. You're not that far. So how do you calculate the market value of debt? Okay. The total nominal value, can't forget these things, huh? Total nominal value divided by 100 by 100. Because in a normal instance, your nominal value of a loan note is 100. That is why you divide by 100. Okay. So you divide by 100 multiplied by market value per loan note. Now ask yourself the question, do I have the information I need? Right? So you have debt is equals to then total nominal value. What is the total nominal value? They've said $14 million is my total nominal value. I will divide by 100 and multiply it by market value per loan note, which is 107.14. When you do that, you get 14 divided by 100 into 107.14. You get something like 14.9996. Shall you round off to say 15 million? Yeah, shall you say 15 million? 15 million. I will then do a small total here to say total market value is this plus this, which is 90 million. So my total market value of the company is then 90 million. Okay. Now see, at the exam, you should have secured at least 2 marks now. Right. So you would have got 75 here and this 15, you should have got at least 1 mark each. Okay. Now calculate the cost of equity. So we'll do a small working, then say cost of equity. Cost of equity. Now how do you calculate cost of equity? Important question. How do you calculate cost of equity? How many different methods have we then learned to calculate our cost of equity? So if you think through it, broadly, you have 2 methods. One is using your dividend valuation model, and the other is being your capital asset pricing model or CAPM. So broadly, if you classify, there are 2 methods. Dividend valuation model is one method. The second method becomes your CAPM or capital asset pricing model. So 2 methods that you have. Now these are the kind of logics that have to be in your head or working in your head whilst you answer question. Okay. So some of you might think, okay, sir, you have taught this for 10 years, hence you have it in your head. Correct. But I didn't tell you not to teach it to anyone else. You teach somebody at home. Right? If you can't teach anybody, teach yourself. Okay. So you draw it up and you pretend to teach somebody and say, okay, there are 2 methods. Now you have to understand what is the most appropriate method as per this question. For you to do a dividend valuation model, what is the key element that you should have? If you want to use a dividend valuation model, what is the key element that you should be having? The dividend rate should be there. Okay. Because if you have the market, already market price is given. If you don't have a dividend rate, you can't use a dividend valuation model because the topic itself says dividend valuation model. If there is no dividend, you can't use it. So you have to understand if there is a dividend, I may be able to use a dividend valuation model. If there is no dividend given to me, absolutely not possible for you to use a dividend valuation model. Okay. These kind of logics have to be working in your head. Number 2, then, okay, I don't have dividends in this case. In the next method I can use is something called my CAPM. What is that one key element required if you want to use CAPM? One key element without which you can't use CAPM. I know there are multiple elements, but one is very key. What is that? The beta value. Without a beta value, you will not be able to figure out, how you can put something in that equation. No way, absolutely no way. Right? So in this question, they have given you beta, and they have given you beta as 0.9. CAPM has 3 main components: your risk-free rate, your market return, and your beta. Right? So if they have given you those 3, yes, you can use CAPM. So under cost of equity, I'm going to say that I'm going to use CAPM, which says that my cost of equity will be equals to my risk-free rate plus beta into RM minus RF. Right? That's what I'm going to use. So based on CAPM, I can calculate my cost of equity. My risk-free rate is 4%. So 0.04 plus beta 0.9 into RM minus RF 0.11 minus 0.04. Okay, so you should get something like 10.3. Okay. Some advice that I always tell students is when you do a question on VAC, work with the easier components first, right? Don't Don't dive into the deep end straight away. Okay. So out of the 4 elements, you now found 3. Now there is only one more to find. Obviously, we are taking time because we are discussing the question and doing it. Otherwise, in 2 minutes, you should have been able to finish off all of this. Less than 2 minutes. Okay. Then what do we have? Cost of debt. But very important that you clearly mention that you're trying to work out cost of debt post tax. Right? Cost of debt post tax. I don't know if I've already told you, but in the exam, don't start with section C. Sorry, don't start with section A, rather start with section C. I don't know if I already told you this. Right? Because what happens is a section C question is 20 marks long. If you run out of time cracking your head over section A and B, and then you come to section C and you start doing a question on section C, and you run out of time, there is absolutely no method for you to secure easy marks. Okay. My advice to students always is start with section C first. Even for my PM students, I tell them the same thing. Start with section C. Multiple reasons. One is you run out of time if you're going backwards. Let's say you started section C, then go to section B, and then you go to section A. If you're doing section A last and you have only 5 minutes, tactic took 1 in 4 times or chance that you can get an answer correct, because most of it are going to be objective type MCQ questions. Some you'll have filling the blanks and all that. So I'll tell you how to tackle section A separately, but work reverse. So we had a panel discussion once from ACCA for, I think, PM or FM, one of those 2 subjects. And in the panel discussion, one of the students had asked, okay, how do you think I should approach the paper? So they were asking all the panel. Then one lecturer told, okay, so the examiner has set the paper as section A, B and C because he wants you to follow the same approach of section A, B and then go to C. So he said, which is his opinion, right? He said, go through section A, then go to section B, then go to section C. Because that is the chronological order of the paper. Examiner has set it for a particular reason in that manner. When it came to me in the panel discussion, I don't know if it's still available online, I told, don't do that. Said, I beg to differ, because he's one of my lecturers. I said, I beg to differ, but my approach to the paper would be this. And I explained to them that if you do section C first, generally, at least in PM and FM, examiner tells you what they're going to test in section C. So you're well prepared. There's no surprise in section C. You know what is coming in section C. So you're well prepared for it. The only thing the examiner has to give you is the question. You know the answer. So let's secure, you secured 15 marks, that's 30 marks. Pressure off, you know. You just have 20 marks to secure over 60 marks in the paper. Very simple. Then you move to section B. Why section B next? Because you still have a small scenario, and based on that scenario, you have 5 questions. The first question is related to second question, second is related to third most likely, so on and so forth. And then you go to section A, which has independent questions. And when you go to section A, you will start with questions that have fill in the blanks. You will start with questions that require to input or underline or whatever. And the last option is your questions that have 4 options for you. Because if you run out of time, in 1 minute, you can quickly click next, click and next. And 1 in 4 chance, you'll get it correct. If luck is on your side, you'll get all correct. Right? So, this is my theory. Up to you all how you all want to face the exam. Okay? Any paper that I have always started, I always start on the back. It's against the logical reasoning of examiner setting it as section A and B. Now, even the professional papers, I tell students, don't start from section A. Because section A is a 50-mark question. 1 50-mark question in section A, 2 25-mark questions in section B. That's it, that's there. So when you go to a professional paper, if you start with section A, 50 marks, for 2 hours, trust me, no matter what time and what watch and Rolex, if you keep in front of you also, you will still use 2 hours for that definitely. And then you realize, oh shit, I have only 1 hour to answer 2 25-mark questions. But you don't realize that 2 25-mark questions is always harder to answer than 1 50-mark question. Correct? No? Because you have to read 2 scenarios. You have to understand 2 scenarios. As opposed to understanding 1 scenario, 50 marks. Choice is yours. Has always worked for me. Has always worked for me. I did 14 papers. You all are doing 13. Right? When we were doing professional, we had 5 levels, 5 papers in the professional stage. You all have 4. The reduced one. So I did 14 papers and I didn't go wrong. Okay. So trust me with this. This is my suggestion, right? I'm not forcing you. After that, don't tell no, sir only forced me. And I did it this way and I screwed up. Your choice. Try it and see. Mock papers, I'll give it tomorrow. We try to mock and see if it works. Right? Okay. Now, cost of debt post-tax. Let's see, if you run out of time at the exam, you have to section C and you have to calculate the cost of debt post-tax, you're screwed, man. Forget about passing. Okay. Right. So, how do you calculate cost of debt post-tax? What is the first question you have to ask yourself when you come to working out cost of debt? See, this student says, I followed what you said. I had 12 minutes left. Right. So, Salma is, I think, proof that the concept works. You can try it and you can also tell me whether it will work. Okay. Good. Cost of debt post-tax, Mister. How do you do it? What is the first question you're going to ask yourself? Now, I showed you, right, my thinking. This whole session is about how I showed you my thinking. Huh? That's it. If you were me, what is the first question that you'll ask yourself when you see, okay, I have to calculate cost of debt post-tax? The first question is, what is the type of debt? What is the type of debt? How many types of debt have you learned? Around 4. Right? You have irredeemable debt, where you have interest paid consistently without a redemption. Then you have redeemable debt, you have interest and redemption value. Then you have a bank loan, a normal simple bank loan. And the other one is a convertible. Generally, that's the 4 that you will have to deal with. So out of these 4, don't do a tuck-tick-took and decide which it is, but based on the question information, what is the type of debt they are asking about? It's redeemable debt. Then ask yourself the question, okay, if it is redeemable debt, then how do I calculate cost of debt post-tax? Okay. Ask yourself these questions at the exam. Don't type in till you know what you want to type in. Okay. So when you ask yourself that question, redeemable debt, how do I calculate it? The easiest method, now it's revision, I'm not going to go back into theory. The easiest method is to work out an IRR. I gave you a 7-column format. Follow the 7-column format for that IRR computation. Okay. So you will do an IRR computation where you have years, then you can have your cash flow, then you have maybe a 5% discount rate, I don't know. Then present value at 5%. So let's work out first, and then you can get the other 2 columns in. So in year 0, you have your market value, which is 107.14. Don't forget to put negative there. Then year 1 to 7, you have interest. How much is your interest? Always remember, interest is calculated based on nominal value. What is the nominal value of the bond? $100. What is your coupon rate? 7% is your coupon rate. So what you can do is take 100 into 7%, but don't forget, take it post tax. And in this case, taxation is 20%. 20%. Right? So you get 5.6. And in year 7, you have a redemption at par, which is $100. You can use your 5% discount factors or anything that you prefer to use. I'm going to go with 5%. So 1 to 7. Yes, 1 to 7, you can use your 5% annuity factor for 7 years, which is 5.786. 5.786 as per the tables. And your discount factor at 5%, 7 years. 5%, 7 years. 0.711. Right. You get a negative 3.6384. So which means you can reduce your discount factor to maybe 4% and calculate the present value at 4%. At 4%, what do you get? This is 6.002, 0.760. Okay. Then you can work out your IRR. I hope all of you can recall the formula. So 0.04 and PB1 2.47 divided by 2.47 minus 3.68 64 into 0. We get something like 4%. Let's check to see. Okay, finished. Okay. So now we'll stitch everything together into your WACC equation here. So cost of equity into value of equity. So cost of equity into value of equity plus cost of debt into value of debt, whole thing divided by value of equity plus value of debt. So in this case, we'll just divide it by 90 straight away. So you get 0.924. It's wrong? Yeah, I took minus minus. So what I did was I took I've taken the wrong cell. Sorry. So it will change the answer. 4.4. Okay. I've accidentally taken 71. Sorry. So small change there. But I think your WACC won't change. No much. 9.93. Same thing. How to calculate IRR using the formula in Excel? You can do it for a standard computation, not for something like this. So, for example, I'll just go back to what we did last week, right? So, if you have these cash flows, right, you can straight away compute an IRR. So, you can just say equals IRR. You can say equals IRR. Take the values from here. Then for a guess, you can just say 0 or you can say 10 or whatever you want. So let's just say 10%. It will calculate the IRR at 86%. Right? So likewise, you can simply do it. But when it comes to a computation like this, where you have annuity in the middle, you will have to either write it down for 7 years straight. Okay. And then only the IRR formula will be able to capture that this 5.6 is there for 7 years. You can do it that method, but it will just take so much of time in terms of writing it. It's faster doing it this way when it comes to a question like this. Okay. Right. So far we have spent like 1 hour, but done only one question or part A only. Okay. No rush, but as long as we're learning in the process. Now they're saying to calculate the cost of equity which could be used in appraising the new project. So this is where that matrix that I drew before comes in handy. So we're going to use something called risk adjusted cost of equity. So how do you calculate a risk adjusted cost of equity? Risk adjusted cost of equity. How do you calculate risk adjusted cost of equity? So when you come into a risk adjusted cost of equity, there are a few steps that I gave you. Do you recall? The first step is to ungear your proxy company's equity beta such that you're able to find the asset beta. Now, you will be wondering, okay, what the hell is an asset beta and an equity beta? Now, looking at the faces, I know you all don't know what is an asset beta and equity beta, correct? No? Fair enough to assume that. Okay. So, when you say asset beta, it is the, okay, before you go to asset beta, first you have to understand what is beta. Beta is your risk factor. So, when you say asset beta, risk factor of your assets. When you say asset beta, what it really means is, if I was to run a business operation, what is the risk I will face? What is the risk I will face? Very simple. But when you say equity beta, what you're really saying is, I'm trying to understand the risk of the business along with my financial risk that I will carry because of any debt I have in the business. So two aspects to it. The first is asset beta. Just going to put this down here. So when you say asset beta, right, last opportunity to learn this, huh? Asset beta, you're talking about business risk. If you're talking about equity beta, you're talking about business risk plus any financial risk you carry. Right? The quick revision here. If you have no financial risk, it is safe to assume, if this is equal to zero, it is safe to assume that asset beta is equals to equity beta if financial risk is zero. Correct? No? We put dummy numbers here, 1 plus 0. 1 plus 0 is 1 again. Mathematically correct? No? Okay. Now, when you work out part B, there are 4 steps that you need to do. The first step is something called ungearing. What does ungearing mean? Ungearing in the sense, from the equity beta, you remove the financial risk component out. When you remove the financial risk component out, what are you left with? Business risk. When you have left with business risk, that beta is then called asset beta. So first step is ungearing. So what you do is you take the proxy company, you ungear it to find asset beta. What does the asset beta represent? The risk factor of the particular business operation without considering any financial risk. Second, what do? You regear. What does regear mean? Now you have calculated the asset beta. Then you look at, okay, Fence company also carries some kind of a financial gearing. I enter into this business, there is a risk, but if I carry excess baggage with me, which is my gearing, I'm also taking a financial risk with me. So then what is my total risk package? My business risk plus my financial risk. So this regearing will help you find out for Fence company what is the equity beta. You with me? Okay. Then third one, use your equity beta and find your capital. Very simple. When you go to advanced financial management, fourth one will be there. You calculate your risk adjusted WACC. But this is not in your syllabus. Okay. Simple. Straightforward. Okay. I want to see you try it out, but put some logical steps into it. Step 1, ungearing, equity beta. Step 2, regearing, asset beta. Step 3, capital. If you write those 3 steps down, examiner knows you know what you're doing. All you have to do to the examiner is to prove to him you know what you're doing. That's it. Very simple. As I said, life is very simple. Don't complicate it. We are very good at complicating life. Okay, I'll give you 2 minutes. Quickly start. Finished. Okay, have we got that? We got what we wanted. Salma and Kavisha. Which one? Equity beta? Yeah. Can you see it or? Suck. What's your status? Do not disturb. Huh? You're in do not disturb mode. Ready for the battle? Huh? To go out there and enjoy, yeah? That's all. Okay, Roshani. Ready for the battle? Hmm? You're working anywhere? No. Full-time student. You're doing only ACCA or anything else? Only ACCA. Ah, okay. Last year. Third year. So you'll get exemption. What's your degree? Okay. Now what's your degree? Ah, okay. So you won't get full. Because you do the accounting special, you get. Okay, Satabadi. Okay. Now see, they spent almost 1 hour on this same question. Part A and B only done. Impossible, huh? Right. Shall we move to the next parts? Explain the difference between systematic and unsystematic risk in relation to portfolio theory and capital asset pricing model. Now, I'm not going to give you an answer. I'm just going to give you the methodology to answer this. Okay, maybe some points. Okay, now tell me, I want you to take a minute, write down few things, write down. No, I want you to physically write down few things that you would have written on the exam. I'll come around and check, or I'll ask you to read from there. One of the two. How did I calculate equity beta? So I used the same asset beta equation. The asset beta is given 1 as per step 1 1.01887. Okay, so to calculate the equity beta, I replaced asset beta with 1.01887. Okay, so let's just come there and show it to the screen. What I did, I took this 1.01887 and replaced it here. Equity beta is 1.5. Equity beta of which company now? Yes. So what is the value of equity? 75. Value of debt. Then I took this and divided by asset. Okay, write down 2 points. Don't have to write full points, huh? Just write few words to say, okay, what am I going to write with regards to this question? That's all I'm asking. It doesn't have to be absolutely correct. It can be horribly wrong, no problems. But you have to write something. Okay, done. What have you written down? Look at the question. What they're asking you is explain the differences between systematic and unsystematic risk. So obviously, first you have to define what is systematic risk and unsystematic risk in relation to portfolio theory and capital asset pricing model. So you have to also write down what is portfolio theory. What is portfolio theory? Yes, a portfolio theory says that investors, being rational, will hold a large enough portfolio such that they are able to diversify their risk. Then the next line would then say, if diversification is possible, they will only be able to remove out what kind of a risk? Unsystematic risk. Then you define unsystematic risk. See how you bridge. Okay. Then you define what is unsystematic risk. Then you say the risk that will remain is your systematic risk. Then you define what is systematic risk. Then you can bring it into PPIM equation. Say systematic risk can then be used in your PPIM equation to calculate your cost of equity or whatever you want to call it. Very simple. You can also mention that the PPIM also is based on the portfolio theory that investors hold a well diversified portfolio. 4 marks. So when you have all of that written, you can't go wrong. Okay, are we good? Happy? No questions? Okay. The last part for 5 marks, discuss the significance of the efficient market hypothesis for the financial manager. Now, what is efficient market hypothesis? Efficient market hypothesis talks about what? How share prices fully and fairly reflect all relevant and available information in the market. Right? And if markets are efficient, then there is no point in financial managers trying to mislead the market, because their attempts will be unsuccessful. If markets are efficient, I hope you are making notes, huh? If markets are efficient, finance managers will not have a particular or specific time for new issue of shares, as share price will always reflect all information available in the market. Exploiting the market will be rather impossible because you have an efficient market. Right, so these are things that will relate to the financial manager. Okay. So we'll take a 10-minute breather today, a short break, and we'll come back and look at further questions, right? So I want you to come back in 10 minutes and we'll look at further questions. Okay, shall we move to the next question? Let's pick a slightly harder question. Okay, we'll start with this question. AMH company. So it says the AMH company wishes to calculate its current cost of capital for use as a discount rate in investment appraisal. The following information relates to AMH company. So equity is given, ordinary shares $4 million, nominal value 50 cents, reserves 18 million. The long-term liabilities are given 4% preference shares, 7% bonds redeemable after 6 years, long-term bank loan. So different types of debt that we have. The ordinary shares of AMH company have an ex-div market value of 4.7 per share, and an ordinary of dividend of 36.3 cents per share has just been paid. Historic dividend payments have been as follows. The moment they give you historic dividend payments, what is the first thing that pops up in your head? There's been some growth in your dividends, right? And that reminds us that when you have a dividend valuation model with growth, there are two methods to calculate growth rates. One is using historical dividends, which is your average growth rate formula, dn over, or sorry, d naught over dn to the power 1 over n minus 1. Second method to calculate growth is using your earnings retention model. G is equals to B into R. So one of the two is what you'll have to use when it comes to growth. In this case, they're given you historical dividends. So most likely, or rather certainly, you'll have to use historical dividend formula. The preference shares of AMH company are not redeemable and have an ex-div market value of 0.4 per share. 7% bonds are redeemable at a 5% premium. So you're not going to redeem at 100, but rather 105. To the nominal value of 100 per bond and have an ex-interest market value of 104.5 per bond. Straightforward. The bank loan has a variable interest rate that is averaged 4% per year in recent years. Company pays 30% as tax. Calculate the market value, weighted average cost of capital of AMH company. So I'm going to give you a head start. I'll give you 5 minutes head start. So you'll start on it. But I want you to think of this question in a very logical manner, just like what we did before. So first thing, write down an equation for WACC. Fill out all the components. Now in this case, you have 4 components. Cost of equity, cost of preference shares, cost of redeemable loan notes, and cost of bank loan. Right? So write down an equation which includes all of these 4. Then you have 8 elements to find. Value of equity, value of preference shares, value of bank loan, and value of your redeemable debt. And likewise, you will have 4 costs to calculate: cost of equity, cost of preference shares, cost of redeemable loan notes, and cost of your bank loan. Don't forget 30% interest. Okay, right, quickly work it out. Give you a 5-minute head start. Let's check if we got 11.3. Cost of debt. Salma and Kamisha, okay? Okay, have we done? Finished. Right. So part B says discuss how the CAPM can be used to calculate a project specific cost of equity, referring in your discussion to the key concepts of systematic risk, business risk, and financial risk. Now, this is what we discussed in the previous question as well. But in the previous question, you also had to do one working. But here, you have to just take down or write down rather an explanatory note as to how you would have done your computation. Okay. So in this answer, you can just write down the points. In this answer, you have to cover the 3 steps that we discussed in the previous question, which is ungearing, regearing, and the application of CAPM. You have to answer, write down those 3. Whilst you write that, you can obviously talk about what your business risk is, what is your financial risk, and what does systematic risk mean. Right? So whilst you do all of that, you should be able to write down these three definitions as well. The moment you have all of that, that should give you the suggested 8 marks. Okay. Right. So with that, we'll move to the next question. I'm just picking up a few different sorts of questions. So I want you to look at this question called GXG company. So what I'm going to do in this question is give you the thought process. Then I want you to work it out and then we'll discuss. Okay. Right. So look at this question. It says GXG company is an e-business that designs and sells computer applications for mobile phones. The company needs to raise 3.2 million for research and development and is considering 2 financing options. Option 1, suspend dividends for 2 years. That is, year 1 and year 2, you don't pay dividends. Then you pay 25 cents per share from the end of the 3rd year, increasing dividends annually by 4% per year in subsequent years. That is, to perpetuity, it will increase at 4%. Now, the first thing that you have to understand is year 1 and year 2, there is no dividends. From year 3 onwards, there is a dividend coming into play. And that dividend is going to go into perpetuity and with growth. Then you have to consider, how am I going to tackle a delayed perpetuity with growth? I told you there are 3 types of perpetuities. The standard normal perpetuity, which starts from year 1. An advanced perpetuity, which starts from year 0. And you can have a delayed perpetuity that starts any period after year 1. In this case, year 3. Right? So think about it. Yeah, so beginning of the year, 4th year or end of year 3 is the same. So you can consider it to be year 3 end. Is what they're saying. So they're going to increase dividends by 4% per year, but dividends in the recent years have gone by 3% per year. Okay, so that information might be useful later on, we don't know. Option 2, could issue 3.2 million of bonds paying annual interest of 6%, redeemable after 10 years at nominal value. Straightforward. Recent financial information relating to GXD companies as follows: operating profit 3,450, interest, profit before tax, profit after tax, and your dividends. What is this dividend? 1,600. This is a dividend that they would have just paid some time back. Okay, the last dividend. Ordinary shares, nominal value 50 cents, 5 million given. Under both options, the funds invested would earn a before tax return of 18% per year. Before tax return, that's profit before tax. Profit tax rate paid by the company is 20%. The company has a 9% cost of equity, which is expected to remain constant. Required using the dividend valuation model, calculate the value of GXT company under option 1. And advice with option 1 will be acceptable to shareholders. Calculate the value of the company. So which means you will have to use option 1 and then work out what your profit after tax is going to be. Or and calculate the value of GXT company. How do you calculate the value of GXT company? You can take the number of shares multiplied by market price per share also. Advice with the option 1 will be acceptable to shareholders. Now, how would you identify whether it is acceptable or not? How would you identify? Now let's assume you're a shareholder. I come with this proposal and then you are asking me, okay, prove to me that this will benefit me. What kind of a proof are you looking for? Okay, let's revert that. Let's say maybe an earnings increase. Okay, anything else? More than an earnings increase? You're telling a lot of things. Partially correct. Let's take something out of it. So you said dividends increase, which corresponds to profit increase, and they all already telling us that there's going to be a 4% growth in dividends. So there is some benefit for the shareholders, apparently, is what we're saying. But what you have to look at is from a shareholder's perspective, if my share today is 10 rupees and tomorrow it's 12 rupees, I will definitely be happy. Okay. When you're evaluating a shareholder's perspective, what you said is correct. Increase shareholders' wealth. But there are multiple parameters in it. One is dividends, one is capital gains. Dividends is already addressed in the question. Then see whether there is a capital gain that is coming in. What is the capital gain? A share price increase. So compare today's share price with what possibly could be the share price if you go ahead with option 1. If there is an increase in the share price, it is worth it. Make sense? No? Logical sense? Very simple, right? Okay, same for option 2. And option 2, maybe you can look at, there is no share price to be calculated here, but from so sorry, Papi is very direct. They are saying earnings per share and interest cover. So taking up option 2, what is happening to your earnings per share? What is happening to your interest cover? If your EPS increases, good. If your interest cover increases, good again. Now let's say interest cover reduces. Would you put a comment to say the company is, or it's not a good option? Let's say interest cover reduces. Would you then say or put a comment to say that the interest cover is bad, it is reduced, it's very dangerous, don't go ahead with it? Okay, let me take one step back. I assumed you know this, but looking at your faces, I know you don't. Okay, now I'm not going to ask you what is interest cover, because I believe you know what is interest cover. Right? The amount of times you can pay interest with the amount of profit you have. A high interest cover is good or bad? Let's put it that way. A high interest cover is generally good because there's a good safety net. Let's say the interest cover reduces. Would you then put a negative comment in the exam? That's my question. I'm asking a very simple question. Interest, okay, understand, interest cover reduces. Understood? Now, when you have seen interest cover reducing, would you put a good comment or a bad comment about the company? That's all I'm asking. Good or bad? You just have to give me one word, man. Good or bad? Bad. Okay, why? It's your subjective opinion. It's your perspective, not mine. You tell me your opinion. You're saying bad. Okay, you tell me why. Since it's issuing new debt, okay. It's not negative. I'm saying it's reducing. Number of times reduces, okay, but is it a good thing or a bad thing?
No tax.
Let's leave tax out, focus on interest cover. I'm only asking you this because I know in this question it will reduce. Technically it will reduce. Why? Because you're increasing the amount of loan, but I don't think proportionately your profit is increasing. My expectation is that. I don't know the exact answer. My expectation is it's going to reduce. But I'm anticipating that all of you are going to write down. I'm anticipating. Huh? I'm not saying this will happen. It's my hypothesis. I'm anticipating all of you will write interest cover has reduced from, let's say, 15 times to 5 times. And therefore, it's very bad. Increased risk. We'll calculate the interest times and we'll come to it. But I'm not getting the right answer from you. Okay. Check your interest cover. If it reduces, you tell me. If it doesn't reduce, we don't have a problem. If it reduces, you raise that hand, tell me it has reduced. Now what do we say? Okay, we'll come to that point later. Right, I'll give you 10 minutes. I want you to answer part A and B quickly. I gave you the structure. I told you what is required. You have to do the work. Okay, hurry up, quickly. Finished. Have you got this? No. Abdullah? Okay, where did we go wrong? Let's reconcile part A first and then go to part B. Yeah? Isaac, are you okay? No, you didn't get it? You got it? Roshani? You got the same thing? No. What mean? 0 out of 4. Okay. Did you all calculate the new share price with growth? Did you get something like 4.3784? No? Anything similar to that answer at least? Let me make a correction here because they're saying this is from the third day onwards. So I'll just remove the growth factor from the top. Maybe that's something. Okay. Did you get 4.21? I made a small adjustment to my answer. Get 4.21? No? Why you didn't discount? Okay. Abdullah got 5. You also didn't discount. Okay. Roshan, did you get 5 and then discount? You didn't get 5 also. You suck. Okay. So why do you discount? Why do you discount? See, what happens is year not, what is your dividend? 0. Year 1, what is your dividend? 0. Year 2, what is your dividend? 0. Year 3, what is your dividend? 0.25. This is what they're saying, right? 25 cents. Now, when you apply your perpetuity factor, standard perpetuity factor says a standard perpetuity will start from year 1. When you divide by R, you go back how many years? You go back 1 year, because you're finding the present value. You go back to year naught. So from year 1, you go back to year naught. So technically, if you start from this point and you discount or divide by R minus G, how many years back do you go? You go back only 1 year, which then means you go back to year 2. Correct? Yes, no, I don't know. Yeah? Okay. So when you go back to year 2, it's insufficient because you need to find the present value. Why do you find the present value? Why do you find the present value? Why can't we be happy with year 2? Why do we have to find the present value? It's not in the question. Why? Why have they asked today, sir? As I said, it's not in the question.
Yes.
Yes, the question based on our answers will make a decision. Today's
I can find my share price in 2 years' time, no problem. Because you forgot the principle. What does the principle say? Market value of investment is equals to what? Present value of simple. I told you. If you forget this, screwed. Exactly what you forgot. I generally don't lie. When I was small, I was a butter liar. Big liar, big time liar. Then I realized for every lie I tell, I have to have another lie to cover it up. Correct? No? Once I got caught lying, I won't tell why, how. I got caught lying. I was one of the most notorious kids. Huh? When I started lecturing, my friends were very surprised. Can you lecture? I don't know whether I can lecture or not, but apparently I can. I was a notorious kid. Huh? Notorious. In any aspect. Open the mouth, it's all lies. If I do something, the worst thing that could have ever done. I have around 60 stitches around my body for amount of notorious things I have done. I don't have skin on my shoulder here. So the notorious things I have done. Right? That's the kind of guy I was. Now I've stopped lying. Now I realized I can't lie anymore. So when I say something, there's some truth in it, so believe it. Okay? Okay. So I told you, write this down on your bed. Repeat 3 times in the morning and night. It's like this doctor can give you medicine. Like when the doctor gave me medicine, I know when he's writing it, I know I won't take it. That's why I fall sick quite often. I don't take it. My wife is now putting goggles and binoculars and watching at me, looking at whether I'm taking the medicine or not. Okay, so same thing. I can say, you have your part to do also. Okay, right. So this is why you calculate the present value. Now you understood that, no?
So, calculate the dividend per share. Price, right?
Yeah. So here what I have done is rather than calculating the dividend per share, I have taken the total dividends and then calculated the total value divided by number of shares to get the market price per share. Same thing. 2 methods of doing it. So then if you have calculated the current share price of 2.74, you will come to realize that if you go ahead with the option 1, your share price is going to increase by 1.46, which is a significant increase, which means has to be acceptable to shareholders. So you have to be able to write down these points. Acceptable to shareholders, you have to say that. Okay, now look at option 2 quickly. Option 1 I have done for you. Quickly look at option 2. Always know why you're doing things. Don't blindly follow. That's the worst thing that can happen. Okay. Okay, finished. What happened to option 2 then? Option 2. Now, option 2, they're asking you to calculate the effect on earnings per share and interest cover. Okay. So, if I was you, what would I have done for option 2 is written down a similar financial statement. I don't know what you did. First thing, ask yourself, is operating profit changing? Is operating profit changing? What they're saying is, under both options, the funds invested would earn a before tax returns of 18% per year, which I believe is something like an operating profit increase. So if I was you, I would go ahead with the same format examiner has given. Don't complicate life. Don't complicate life. Operating profit. So what is happening to operating profit? What they're saying is it's going to increase. By how much? By 18% of the amount of funds you have invested. So you have 3.2 million you're investing, right, into 0.18. That is the return that you're going to get from the investment you make. On top of that, you already have 3.45 million of profits. Correct? You're with me? Don't lose me. Enter. 4,026,000. Have you got this? Okay. Right. What else are they saying? Interest. What will happen to interest? Interest will now increase. How will interest increase? You're borrowing 3.2 million. You're paying interest of 6% plus the amount of interest you have already paid, 200. So total interest 392. Then profit before tax, 3634. Then take tax 20% per year. Profit after tax, 2907.2. Have you got this? Then you can calculate revised earnings per share. So divide by number of shares. So how many shares did we have? I think we got 10 million shares. These are in thousands, so we'll have to work in 10,000s. So we have 10 million shares. So EPS 0.2907. 0.2907. What was the previous earnings per share? Previous. So what I'm going to do is move all of this here. And put the previous ones. What was the original values? 3450, 200. So this minus this. Then tax 650. So EPS has increased. Can you see? EPS has increased by how much? Small value, but that increase is important. So long as there's an increase in EPS, you should be happy. You should be happy. Okay. Right. What happens to interest cover? I think we discussed interest cover before. How do you calculate interest cover? How do you calculate interest cover? Yes, interest divided by operating profit. So you have, sorry, the other way, interest, profit of interest. 17.25 and 10.2. This is the same question I asked you before. Profit over interest, which means we had 17 times that we could cover interest with the current profit that we have. But now it's only 10.2. Now the question, is it good or bad? If you say bad, tell me why. If you say good, also tell me. It's your personal opinion. At the exam, I'm not there to look, did you write good or bad? Or why did you write good or bad? Tell me. Why? No, don't give me the... That's why you're doing a relative measure. No? It's a relative measure. In comparison to last time, it has gone down. So, good or bad? That's all I'm asking. Huh? No, don't say both. That's not all she also said. So, I'm giving the same answer that I gave her. It's okay. So, it's like this. 17.25 is really good. 10 is not bad. That's my conclusion. 17.2 is really good. 10 is also not bad. No? Nobody should have a problem when you say, okay, I can cover my interest 10 times. Nobody should be up. You have to come to understand that measuring financial risk can be done in multiple methods. One is gearing, the other is interest cover. Interest cover is actually a measure for financial risk. So when you have a interest cover of 17 times, it shows there is negligible financial risk. At 10 also, there is still negligible financial. No equity holder or no shareholder is going to get worried to say, okay, only 10 times. And 5 times they'll be happy. But if it gone from 17 to 5, they might raise some eyebrows. It's good. That's what I said. It's okay. No issue. Nobody's going to have a concern. Okay? Right. So take it down and then you can write down those comments what I just mentioned. So which one? Why? But that won't impact our EPS calculation or interest cover calculation. If you are finding the cost of debt, you might need it. Apart from that, no. Okay. Okay. Right. So very simple stuff, huh? Okay. So part C says discuss the factors to be considered in choosing between traded bonds, new equity issue via a placing, and venture capital as a source of finance. So what do you say there? So you have to discuss what is a traded bond. So what is a traded bond? Obviously you have a debt, it's a debt security where you have redemption, so maybe between 5 and 15 years, and it will be secured on some kind of a non-current asset, so on and so forth, right? Interest that is paid on the bond will be tax deductible, and therefore the cost is significantly lower than cost of equity. Then you move to equity, then you say, okay, finance does not have to be redeemed, it is perpetual, and the return to shareholders is in the form of dividends, and dividends will depend upon the company's performance. If the company is doing well, you pay off dividends, otherwise no. And these dividend payments are not tax deductible, and therefore can be more costly in comparison to debt. And then finally, you can talk about venture capitalists, where you're financing for a specific situation, generally high risk finance. And therefore, the return required is going to be significantly higher. Okay? And okay. Right. Make sure you wrote those points. Huh? Then I'm going to do one more question before we wrap up for today. Let's look at this question further down. Okay, look at this question called THP company. Salma, we can ask PPIM to share the Excel sheet. Okay. So it says here THP company is planning to buy CRX company, a company in the same business sector. As it's considering paying cash for the shares of the company, the cash should be raised by THP company through a 1-for-3 rights issue and a 20% discount to its current share price. 1-for-3 means if you have 3 shares, you get 1. The purchase price of the 1 million shares issued by CRX company would be equal to the rights issue funds raised less issue costs of 320,000. Earnings per share of CRX company at the time of acquisition would be 44.8 cents per share. As the result of acquiring CRX company, THP company expects to gain after annual tax savings of 96,000. THP company maintains a payout ratio of 50% and earnings per share are currently 64 cents per share. Dividend growth of 5% per year is expected for the foreseeable future, and the company has the cost of equity of 12% per year. Equity and liabilities, shares 3 million, reserves 4.3, non-current liabilities 5 million, 2.2 million. Further information, THP company's dividend per share is 32 cents per share. Share price is 4.8. Market capitalization 14.4. Price earnings ratio of 7.5. So let's take a few minutes and work out part A first. We'll discuss and then move to part B and C. Assuming the rights issue takes place and ignoring the proposed use for the funds, calculate the rights issue per price or price per share, the cash raised, theoretical X rights price per share, and market capitalization of THP company. Okay, for 4 parts, 5 marks, should be straightforward, ideally. Okay, so I'll give you 5 minutes, just quickly work it out. Same thing. Market cap, number of shares into price per share. But here they are saying that there is a 320,000 issue cost incurred. So you have to deduct that for your market capitalization. That's the only change in this question. Okay, so they're asking to comment, they're not asking us to comment. Look at part B. Using the price earnings ratio method, calculate the share price and market capitalization of CRX company before the acquisition. So what is the price earnings ratio method? PE ratio. What does the PE give you? MPS over EPS. Okay. So what is your PE ratio here? PE ratio they've given you is 7.5 times. Correct? Do you see that 7.5? Okay, so based on that 7.5, see if you can calculate what the share price of the company would be. Multiply that by the number of shares to get you market cap
So, see,
of CRX company before the acquisition. Because they're in the same industry, we can use the same P ratio, right? Otherwise, there's no P ratio given of CRX company. It's only THP company. Okay. Finished?
So how do you get the EPS?
How do I get the EPS? Question.
EPS.
MPS. So MPS would be P ratio into EPS, no? Okay, Isaac. Roshani, you okay? Salma, how are you? Okay? No, why? What happened? What's the problem? So difficult. What is difficult? Easy, no? Multiplying two numbers, adding two numbers. Grade 5 math is more difficult. What's difficult out of jokes, Salma? Oh, okay. Except for cost of capital, she likes everything else. The wrong topic to do today. No, rainy day, no. But see, if I was you, I would. For me, it's obviously the other way. I love cost of capital. It's my favorite topic. I just love cost of capital. It makes a lot of sense, no? Very logical. There's things that it's okay. It's just preferences, preferences. Okay, don't scare me saying everything is difficult. Okay, part C. Interesting one. Assuming a semi-strong form efficient capital market. Now you have to come to understand, okay, what is a semi-strong form efficient market? Shall I off the AC? Cold. Your brain's also frozen. Okay, now it will work. What is a semi-strong form efficient market? What does semi-strong form mean? Semi-strong. What does that mean? I knew you will say that. I was waiting for that answer from this guy here to say that partially strong. What does it mean? Private information. Okay. Both. Okay. Isaac, what do you see? Okay, let's start from the beginning. What is weak form efficient? Share prices reflect what information? Past information. Everybody's reaction is the same. Okay. Then semi-strong form, past and publicly available information or present information. What is strong form then? How can you have future information? Past, publicly made available information and private information as well. In today's world, where do most stock markets sit? Weak, semi-strong or strong? Semi-strong. Because you can't regulate against private information. Of my company, I know information. I can always tell you, go and buy stocks today. Right? But my company is not publicly listed now. Okay? So you can't buy shares. So now you've understood semi-strong form efficient capital market. Calculate and comment. Very important. Calculate and comment. On the post-acquisition market capitalization of THP company in the following circumstances. First question, post-acquisition market capitalization. Like, difficult words, no? Difficult words. Break it down. Post-acquisition, what does that mean? After acquisition. Market capitalization, everybody knows. Market capitalization, you know, because you did that now. Market cap is market capitalization. So after acquiring, what is the market capitalization? Is what they're asking. Very simple. Part 1, THP company does not announce the expected annual after tax savings. Now when you're semi-strong form, if you don't tell people that there is going to be a synergy, will people know? They won't know. And then they will place a value on your company based on information they know. Now you have to assume we haven't told the market there is going to be a synergy of 96 or whatever the 1000 was, and calculate market capitalization assuming that synergy does not exist. Now when it comes to market valuation post acquisitions, I gave you a standard formula. Do you remember? What is the formula again? I told you, at the end of this subject, you will have close to 85 formulas. Then in day 1, I told you, take a paper, fold it into 2, start writing all your formulas. First day, everybody is excited. They write all the formulas. By the end of the 20th week, that paper is also missing. People have forgotten I have asked to write the formulas. Only one session. And one student who wrote all the formulas. That is how I know there is 85. I don't know, otherwise 85 formulas. My lecturer didn't tell me to do what I am telling you to do. In fact, I self-studied also. I didn't go for lectures for financial management. That is a stupid easy subject. The only subject I went for lectures, no, don't go and tell CR. I did was I went for audit and tax. 2 technical subjects I can't do without a lecturer. Audit I had to go because I don't know what audit is. Then I realized that's also bullshit. Tax, you have to go for lecture. Very difficult. There are some very small things. You have to know the nitty-gritties of everything to do bloody tax. But once you know it, it's easy. Income tax computation for personal or whatever, personal income tax computation or whatever that is. I can't even remember now. The bloody format is there. You write down the same thing every year. Only thing you reference the table and see whether the values have changed from last time to this time. That's it. Then inheritance tax, there will be a question. You do that, very simple. Anyways, ACCA is very easy, man. Okay, people make you feel scared. It's not very difficult. Very simple, right? The problem with students is they panic. They panic. You know why they panic? I'll be very honest. They're all Sri Lankans. When you pay something in pounds, you will definitely panic. That's the only reason. Otherwise, there's nothing to panic. Just assume. Let's assume. Okay, you're paying. How much is your paper? 200 pounds, no? To the early bird discount. Okay, 143. You pay 100. Let's assume it's 143 rupees. Will you be ever scared to go and sit in exam? Come what may, you will go and sit and go. Now with 143 pounds, no, and it's not your money most often, get a little afraid. That's it. For a person like me, I paid my own exams. I had no fear. If I fail, I'm answerable to myself. I don't have to go and tell my parents. So when you have that fear factor out, no pressure. Then I realized most of the people put pressure upon themselves not because they want to pass the exam. They're scared, to go and tell their parents or whoever paid the money, I failed the exam. That's it. So remove that fear factor out. You will do the exam and don't worry. Very simple. Okay. Now I gave you a standard formula. So when you don't do things I say, we go all around the mulberry bush and come here again. Okay, now what is the formula? I don't know. Is the formula? I know that's the answer you're going to give me. I don't know, sir. Company A plus company B plus synergies minus cash pay. Now remove the synergies out. Why? because we are assuming semi-strong form efficient market and we have not made the announcement that there is a synergy. So nobody in the market knows there is synergy. Now, if the question says assuming strong form, then what happens? Then you have to add the synergy because private information is also reflected on share price. I doubt they'll give you something like that. I doubt. Okay? Understood? Okay. Now write down the equation and work out and tell me what is the share price or market cap for part 1. Salma says tax is easier than this. No, no way. Tax is easier, you will have a higher pass rate. I think tax is the lowest pass rate after PM. PM is the lowest, second lowest is tax. Audit now has increased 40 plus. I don't know, when I was looking at tax before, it was like 30 something. When I did tax paper, pass rate 30%, which means 70% of people fail. Okay, do. I have 10 years of stories of ACCA to tell you all. I can't tell every day, everything in one day, so don't worry. Okay, now do the question. How much do you get there? Market cap. Market cap. Assuming no synergy. So take company A. What is company A's market capitalization? Did we work it out somewhere? Yes, 17.92. Plus company B's market capitalization. Did we work it? Yes. Minus the cash paid. What is the cash paid? That also we put somewhere, no?
In the equation itself. Yeah, for the first one.
It's under 17.92, I believe, no? Okay. No, that 320,000 was not the cash paid, no? That was the issue cost, no? What is the cash paid?
Yeah, right.
That's the cash raised. So that will be this 384 minus the issue cost, no? Basically. What was the issue cost? 320,000. Okay. So we remove the cash paid minus the issue cost, because issue cost you can't pay to the company now. That will go to the people who are issuing the rights issues. Okay, so 17.76 is your market cap. So in number of or in per share terms, how much is this? You're going to raise 4 million shares, or you'll have total 4 million shares. MPS would be this divided by this, you get 4.44. So what has happened now? Good or bad? Good or bad? Good or bad? Good. Why? Because you see 444. 3 fours. No, it's not good. Why? Earlier market capitalization was? Exactly. Your 4.48 before has now reduced to 4.44. What does that mean? What does that mean?
Not a
Share.
No, I know. No, everybody knows. Even my 4-year-old daughter knows 4.48 to 4.44 means share prices come down. I'm asking, what does it mean? Share prices come down. Why? Let me ask you something else. Let's say, okay, I paid cash. I think the problem is you don't see the steps, no? Okay, you paid cash. How much of cash did you pay? Can someone tell me? You raised 3.84. From that issue cost 320,000 deducted. You paid 3.52 million cash. To whom did you pay this cash? To? Give me the name. CRX. You paid to CRX. How much is CRX worth? $3.36. You see the problem? You have paid 3.5 to someone who's only worth 3.3. Problem or no problem? Problem. That is why your share price has fallen from 4.48 to 4.44. Okay, so that's going to be your comment. Huh? Right. Now, do the same thing, but assuming synergy is present. Okay, try and see quickly. What happens now? Okay, finished. What did you get? Okay, let's see. So I'll take the same market cap from here. Is that okay? And we'll just add the we have to just add the Synergy, right? What is the synergy? How much? 90? Okay. What is 96,000?
Tax.
After tax annual saving. What does that mean? What is after tax annual savings? Hmm? How much we have to give out as? Okay. You're looking down, looking at me, looking down. I guess suddenly you're going to get some revelation from somewhere. So I'll bring the synergies in. Now, if you put 96,000 here just like that, is it correct? Correct. Why? When I ask, is it correct? I know definitely will say no. Is it correct? No. Why? It's not the answer. Ideally, you have to look at the present value of this opportunity that you're going to get for X number of years.
Perpetuity.
We don't have any information to go ahead with the perpetuity. So you can estimate your present value of this synergy by doing a simple computation where you take 96,000 and you multiply it by your PE ratio of 7.5 times. Estimation of present value. Because if you look at the P ratio, what does it do? Your P ratio is MPS over EPS, no? Or P ratio is equals to market value over total earnings. Correct? Either way the same thing, no? Either you take it on a per share term basis or total value basis. Now, in this case, I have been given 96,000. What is that 96,000? It is the additional earnings I am going to get on a per share basis or total value. Per share basis or total value, 96,000. Total value, which means my total earnings, assume 96,000. So if I ask you P ratio, market value divided by 96,000. Correct? No? Now, do I know my P ratio? I know my P ratio. So I will replace here by 7.5. What do I see happening? I derive something called market, which means this synergy is going to generate 7.5 times increase in my market value. That total is 720,000. So technically, this will give you your total new market value. Number of shares won't change. So MPS is 4.62. Now what happened? Good or bad? Now good. Why? What is the capital gain you have? The capital gain you will have is 4.62 minus what you had initially, 4.48. 0.14 per share or 14 cents per share. It's good. Good. Okay, take it down. You can write your comments. Okay, finished. Right. Last one. Discuss factors that THP could consider in circumstances in choosing between equity finance and debt finance as a source of finance from which to make a cash offer for. So what are the factors that you need to consider? Obviously, number one should be availability of finance. Availability of finance. What is available to them? Is it equity or debt? And debt will obviously need some sort of security. So do they have some collateral securities to provide when they want to obtain debt? Third one can be your gearing. What happens to your gearing ratios? So you can do a small calculation also and show current gearing if you have equity, gearing if you use debt. Do that computation and show comparison. So it becomes a little more realistic, or let's say application is done in the question. Then dilution of control is another thing that you can talk about with equity. Okay, so I think those 4 or 5 points should be okay. Good.
Business finance and business valuation.
Business valuations is a separate topic. So this question it is now under business valuation. Efficiency. Okay, shall we stop there? Good. So I'll see you then next Sunday. Like I told you, we'll be doing a class on 31st, which is Saturday. Okay? Because first of June we won't meet. No? June is June. Good. See you then later.